Silver didn't become a headline by accident. It became one because a bold prediction collided with a market already under pressure. When Robert Kiyosaki talks about silver reaching $200, people listen, not because he's always right, but because his words arrive when emotions are already elevated. Right now, silver is exactly in that emotional zone, but here's what almost no one is discussing. The prediction itself might be the trigger for what comes next, not the breakthrough everyone expects, but the reset no one is prepared for. Markets don't move in straight lines when expectations are this crowded, and silver never forgives those who mistake a destination for a timeline. So before you position yourself based on a number, you need to understand what silver does before it gets there. Welcome to Boring Currency. I know the name doesn't exactly scream excitement, does it? But then again, neither does watching your portfolio bleed because you missed what the market was actually telling you. If you've been around long enough to remember when financial news wasn't just noise, when analysis actually meant something, then you're exactly where you need to be. We don't do hype here. We do structure, we do clarity, we do warning signals that matter. So if that resonates with you, go ahead and subscribe. Not because I need the number, but because when silver moves fast, and it will, you'll want to know what's happening before the crowd figures it out, and drop a comment below. Let me know where you're watching from. Because market behavior changes by region and your perspective matters. Now let's get into what's really happening with silver. Silver did not suddenly become a headline by accident. It became one because a bold prediction collided with a volatile market. When Robert Kiyosaki talks about silver reaching $200, people listen. Not because he is always right, but because his words arrive when emotions are already elevated. Right now, silver is exactly in that emotional zone. Let's ground this before it runs away. Compared to yesterday, silver is holding firm after sharp moves. Price is not collapsing, but it is not calm either. That alone should raise caution. Markets that move violently and then pause are not resting. They are deciding. Now zoom out slightly. Compared to last year, silver is in a completely different regime. Last year, silver was building momentum. This year, silver is managing excess. That matters. Last year was about discovery. This year is about digestion. Silver has already done the hard work of repricing higher. Now it's dealing with the consequences of that move. This is where predictions like $200 silver become dangerous, if misunderstood. Not because the number is impossible, but because timing is everything. Silver is not a straight escalator, it's a staircase with missing steps. Investors don't fall because the destination is wrong. They fall because they step when the floor isn't there. Kiyosaki's prediction works like gasoline on an already warm engine. It increases speed, not stability. That's the warning. When silver runs too far, too fast, belief replaces balance and markets punish that. This year compared to last year, volatility has expanded dramatically. Daily ranges are wider, pullbacks are sharper, recoveries are faster. That tells observers silver is under pressure, not losing relevance. Pressure is not weakness, but it is dangerous. Think of silver like a pressure cooker without a clear release valve. As long as heat builds, the lid rattles. That rattling is what market participants are seeing now. Kiyosaki's $200 call adds heat. It doesn't remove risk. The problem is not optimism. The problem is positioning. Many people hear a big number and assume time is irrelevant, that holding through anything is the strategy. Silver doesn't reward that mindset. Silver rewards patience and punishes stubbornness. Compared to last year, leverage in silver markets is higher, participation is broader, and expectations are louder. That combination creates fragility. This is where the general structure matters. Silver is smaller than gold. Its liquidity is thinner. Its dual role makes it more reactive. When confidence rises, silver surges. When confidence cracks, silver drops harder than expected. This is why silver can feel like it's betraying holders. Even when the long-term story hasn't changed, it's not betrayal, it's mechanics. Kiyosaki's prediction should be treated like a weather forecast, not a calendar reminder. It tells investors a storm may come. It does not tell them when the wind shifts. Right now, the silver market is not aligned for smooth upside. It's aligned for turbulence. That doesn't invalidate bullish scenarios, but it absolutely invalidates complacency. Compared to yesterday, silver is still tense. Compared to last year, silver is overheated. Compared to a decade ago, silver is operating in a completely different demand environment. Those facts can coexist. This is why warnings matter now, not warnings of collapse, warnings of misinterpretation. Silver can eventually move much higher and still hurt people badly along the way. That's the trap. The mistake is thinking a bold prediction means a straight path. Silver never moves in straight lines when expectations are crowded, and right now expectations are crowded. The market is thinning under the surface. Liquidity steps back when volatility rises. That's when sudden drops happen, not because value disappears, but because balance breaks. This is the environment where silver tests discipline. If someone is holding silver today, the most important question is not whether $200 is possible. The question is whether they understand what silver does before it gets there, because the journey is where most people lose conviction, capital, or both. This is not the moment for blind confidence, it's the moment for awareness, and that brings observers to the next issue. If bold predictions raise expectations, and if volatility punishes poor positioning, then what actually drives these sudden drops in silver? The reason silver punishes investors after bold predictions is not psychological, it is mechanical. This is where most commentary fails. Silver does not fall because belief disappears, it falls because leverage breaks. To understand this, one must look at how silver actually trades. Unlike gold, silver futures require less capital per dollar of exposure that attracts leveraged participation. Historically, silver moves about 1.5 to 2 times faster than gold in both directions. This is not opinion, it is observable behavior across decades. When silver rallies sharply, margin usage rises. When margin usage rises, risk increases silently. That silence is dangerous. One verified fact matters here. The futures market for silver is many times larger than annual physical production. That means most price discovery happens in paper markets first, not in vaults, not in factories. When margin requirements increase or volatility spikes, paper positions unwind fast. Physical demand does not disappear, but paper pressure overwhelms price in the short term. This is exactly why silver can drop hard, even while industrial demand remains strong. Now connect this to today. Compared to last year, silver trading volumes are higher. Open interest expanded significantly during the rally phase. That expansion confirms participation increased, not just price. More participants means more leverage. More leverage means more fragility. This is where Robert Kiyosaki's prediction intersects with reality. When influential voices project large upside targets, speculative interest grows. Not all of it is reckless, but some of it is. That additional participation raises open interest and margin exposure. It does not add physical supply. This creates imbalance. Think of it like adding more cars onto a bridge without reinforcing the structure. The destination doesn't matter. If the bridge can't handle the load, silver's bridge is narrow. Another verified layer is supply. According to the Silver Institute, global silver supply has been running below demand in recent years, driven largely by industrial usage. Solar, electronics, and electrification are not optional sectors. But supply deficits do not protect price from leverage-driven sell-offs. They only shape the recovery afterward. This is where many investors confuse timing with direction. Silver can be structurally undersupplied and still experience violent drawdowns. Those drawdowns are not contradictions. They are part of how the market resets. Now compare this year to last year again. Last year, silver's rise was gradual at first. Participation built slowly. This year, momentum accelerated quickly. That acceleration compresses time. When time compresses, reactions become sharper. This is why pullbacks now feel worse than last year's pullbacks. The market is carrying more tension. Another verified point is volatility itself. Measured volatility in silver has expanded significantly compared to the previous year. Wider daily ranges confirm this. High volatility environments reward patience but punish leverage. This is where the warning becomes practical. If someone hears $200 silver and assumes they can ignore volatility, they misunderstand silver completely. Silver does not trend smoothly when volatility is elevated. It whips, it overshoots, it snaps back. This is why margin-driven selling often appears at the worst possible moment, right after optimism peaks. The sell-off is not a judgment on silver's future. It is a correction of positioning. This is also why long-term holders and short-term traders experience silver very differently. Long-term holders think in years, the market trades in seconds. When those two collide, price becomes violent. Another verified reality is liquidity distribution. Silver liquidity is not uniform across regions. Some markets hold more deliverable metal than others. When stress hits, price reflects the weakest link, not the strongest. That's why silver behaves like a fault line. Pressure accumulates quietly. Then it shifts abruptly. Kiyosaki's prediction amplifies expectations. Expectations amplify positioning. positioning amplifies risk. That chain reaction matters more than the number itself. This is why the warning is not silver will fail. The warning is silver will test you. Compared to yesterday, silver may look stable. Compared to last year, silver is far more reactive. Compared to a decade ago, silver is operating under entirely different demand pressures. All three can be true. This is the environment where mistakes are expensive. Not because silver is wrong, but because timing and structure matter more than conviction. This leads to the next critical issue. If leverage resets cause sharp drops, and if physical demand doesn't prevent volatility, then what role does supply actually play during these phases? If leverage explains why silver falls fast, supply explains why it doesn't stay down forever. This is the part many people misunderstand. Supply stress does not stop volatility. It shapes what happens after it. Silver is not just a financial asset. It is a working metal. More than half of global silver demand comes from industrial use. That is a verified, long-standing fact reported by the Silver Institute. Solar panels, electronics, electric vehicles, data infrastructure. These sectors do not pause because futures traders panic. They buy when they need metal. That creates a floor, but not a smooth one. This is where the danger lies. People hear supply deficit and assume price should grind higher steadily. Silver doesn't behave that way. When supply is tight but liquidity is thin, price moves like water in a narrow pipe. Pressure builds behind it, then it surges or drops suddenly when flow changes. This is why silver often looks weakest, right before it strengthens again. Now compare this year to last year. Last year, industrial demand was rising, but inventories were still cushioning the system. This year, that cushion is thinner. Global silver inventories are not collapsing, but they are uneven. Some regions are tight, others are comfortable. That imbalance matters more than total supply numbers. Markets don't price totals, they price availability. When metal is sitting in the wrong place, price reacts violently to even small shifts in demand. This is why silver volatility remains elevated, even after pullbacks. Another verified factor is mining supply. Silver mine production has not surged to meet demand. Most silver is produced as a byproduct of other metals, like copper and zinc. That means silver does not respond quickly to higher prices. This is critical. Even if silver rallies sharply, new supply does not immediately appear. That keeps long-term pressure intact, but again, this does not protect short-term holders from pain. Supply tightness acts like a stretched rubber band. It stores energy. It does not control timing. Kiyosaki's prediction leans on this long-term supply story, and that story is not fantasy. But where people get hurt is assuming supply guarantees near-term upside. It doesn't. It guarantees volatility. This is why silver's drops feel confusing. People expect tight supply to act like a shield. Instead, it acts like tension. The tighter the system, the sharper the moves. Now add another verified layer. Silver inventories in major trading hubs have shifted significantly over recent years. Metal has flowed toward regions with higher premiums and stronger demand. That creates regional stress points. When one hub tightens, price responds globally, even if other hubs still have metal. This is why silver behaves like a market with multiple weak joints. One doesn't need the whole system to fail. One stress point is enough. This is also why silver often recovers faster than expected after sharp drops. Once forced selling exhausts itself, there is no equivalent force pushing price lower. Physical buyers step in, not emotionally, practically. They don't chase highs. They wait for weakness. This is where clarity matters again. A violent drop followed by stabilization does not mean danger has passed. It means the market is resetting. Resets can take time. They can involve multiple swings. Silver rarely goes from excess straight into calm. It oscillates. This is why warnings are necessary right now, not because silver is broken, but because silver is unstable. Unstable markets punish impatience. Compared to last year, silver is far less forgiving. Compared to yesterday, silver may look quiet, but quiet in silver often precedes movement. This is where metaphors matter. Silver right now is like a coiled spring under uneven load. Some pressure has been released, not all of it. If someone leans on it without understanding where the tension remains, it snaps. This is why predictions without context are dangerous. They focus on destination and ignore terrain. The long-term case for silver can remain intact, while the short-term experience is brutal. That is not a contradiction. That is silver, which brings observers to the most important question. If volatility is structural, if leverage resets are unavoidable, and if supply tightness keeps pressure alive, then what should actually be watched? Now, At this stage, the most dangerous mistake is watching silver for answers it cannot give. Silver does not tell observers what will happen next in a straight line. It tells them where stress is building. That's what matters now. If Robert Kiyosaki's prediction did one thing, it reminded people how extreme expectations have wrong. Extreme expectations change behavior, behavior changes risk. That is the real signal, right? Now, silver is not deciding its final destination. It is deciding how much excess needs to be cleared first. This is why the next phase is not about price targets. It's about reactions. Observers should watch how silver behaves on down days, not up days. Does selling accelerate immediately? Or does it stall quickly? That distinction tells them whether forced selling is still active. Watch volume, not headlines. When price moves sharply but volume fades, it signals exhaustion. When both rise together, instability remains. Another key signal is recovery speed. In healthy but volatile markets, silver rebounds quickly from sharp drops. In unhealthy ones, it drifts lower slowly. Right now, rebounds exist, but they are uneven. That suggests the reset is incomplete. This is not bearish, it is unfinished. Also watch gold, but do not mirror it. Silver often diverges from gold during stress phases. Gold absorbs fear, silver amplifies it. If gold stabilizes while silver continues to swing, that is not weakness. That is silver being silver. This is where many holders misread the market. They assume silver must confirm gold. It doesn't. Silver leads emotionally and lags structurally. That's why its moves feel exaggerated. Another practical warning involves time. The most painful losses in silver usually come from impatience, not being wrong. Entering too aggressively after a rally, or exiting too emotionally after a drop. Both happen when expectations outrun structure. This is why bold predictions should be treated carefully. They are not roadmaps. They are stress tests. They reveal who is positioned rationally and who is chasing. Silver exposes that difference faster than almost any other asset. Right now, silver is testing discipline, not belief, not conviction. Discipline, if someone holds silver. Today, the most important skill is not forecasting. It is restraint, knowing when not to act, knowing when volatility is noise, not signal. This is where clarity cuts through the warning. Silver can still move much higher over time. Nothing in recent behavior disproves that. But silver does not reward certainty, it rewards preparation. This is not a market to fall asleep in, and it is not a market to panic in either. It is a market that demands awareness. The warning is simple. Silver is powerful, but it is sharp. Handle it like a tool, not a promise. Those who respect its mechanics survive its swings. Those who ignore them become part of the reset. That's the difference. And that's why the conversation around silver right now should not be about numbers alone. It should be about behavior, because behavior tells observers more than any prediction ever will, and silver is watching that closely. With that being said, silver doesn't need hype to move. It moves when pressure builds. Predictions can be useful, but only if people understand the market they lend in. Right now, silver is not calm, and calm is not guaranteed. The mistake isn't believing silver can go higher. The mistake is assuming the path will be easy. If someone is watching silver closely, they should stay focused on behavior, not noise. Volatility is the signal. Discipline is the edge. If this helped them see the market more clearly, they should make sure they're subscribed to boring currency, because silver doesn't give second chances when it moves fast. Let us know in the comments where you're watching from, and we'll continue tracking what silver is telling us next.